Hold on tight, because the market is moving. First, Zacks Investment Ideas is spotlighting Spotify, ticker SPOT, as a potentially undervalued tech play, even with Daniel Ek stepping down as CEO. They're saying this music streaming giant is poised for a rebound, trading at a deep discount despite strong earnings and a massive user base. Plus, they're highlighting Apple, Amazon, and Alphabet as potential buys right now. Is this the moment to jump in?
Here's a simple way to protect your phone without stress. This ALEN 3-pack comes with tempered glass screen protectors, camera lens protectors, and an installation frame for an easier, cleaner fit. It's clear, case-friendly, and built to help guard against scratches and everyday bumps. Check the link in the comments to get it on Amazon.
But that's not all. The tech titans are under the microscope as earnings season heats up. Zacks.com is previewing reports from Amazon, ticker AMZN, Alphabet, ticker GOOGL, Microsoft, ticker MSFT, Meta, ticker Meta, and Apple. They're watching closely to see if these Magnificent Seven companies can prove the profitability of their AI investments, especially with Alphabet's cloud revenue accelerating and Microsoft facing pressure to show Azure growth. Will these giants deliver? And now, a look at the future of computing. Quantum computing is no longer science fiction, and senior stock strategist Kevin Cook at Zacks Investment Research has identified 7 stocks poised to dominate this revolutionary field. Hyperscalers like Microsoft, Google, Amazon, and even Tesla are scrambling to get ahead. Could this be the next big thing, even bigger than AI? Find out how to position your portfolio now. Finally, investors are demanding transparency. Trillium Asset Management is urging Alphabet shareholders to vote for Proposal 5, pushing for enhanced disclosure of how the company will meet its 2030 greenhouse gas emissions reduction targets. With emissions actually rising despite ambitious goals, and AI driving up energy demand, can Alphabet deliver on its climate commitments? Don't miss out on these critical stories. Hit that like button, subscribe to the channel, and ring the bell for more market-moving updates. Despite a recent dip, Spotify is being highlighted as a strong tech stock trading below its peak, offering a potential buying opportunity. The streaming giant, down 33% from its June 2025 highs, is largely shielded from AI disruption and economic headwinds. Despite Daniel Ek's recent transition from CEO to executive chairman, he remains a key figure, focusing on capital allocation and long-term strategy. Spotify's earnings and revenue growth remain robust, with the company now generating impressive free cash flow. The company's ability to consistently raise prices, with recent hikes in 2023, 2024, and early 2026, demonstrates its strong position in the market, where it currently holds approximately 32% of global streaming music market share, significantly outpacing Apple Music at 15%. Monthly active users grew 85% between 2021 and 2025, reaching 751 million, with premium subscribers increasing by 60% to 290 million. Projections indicate further growth, with an anticipated 10% year-over-year increase in monthly active users in 2026, reaching 824 million. Spotify's financial performance is also improving dramatically. It reported its first full-year profit in 2024, soaring from a loss of $2.96 per share in 2023 to a profit of $5.95. Earnings are projected to continue growing, reaching $19.27 per share in 2027. Revenue is expected to grow 19% in 2026 to $26.19 billion. The company's balance sheet is strong, with $10.7 billion in cash and near-zero long-term debt. Despite recent earnings revisions, Spotify has consistently exceeded EPS estimates, crushing them by 63% and 105% in the last 2 quarters. Currently trading at a 60% discount to its one-year high, analysts suggest a strategic purchase now, potentially adding to positions later, particularly ahead of its Q1 earnings report. Chicago, IL, April 27, 2026. Investors are closely watching earnings reports from the Magnificent Seven tech giants this week, as Zacks.com highlights potential earnings surprises. Amazon, Alphabet, Microsoft, Meta, and Apple are all on the radar, with Amazon, Alphabet, Microsoft, and Meta reporting Wednesday, April 29th, and Apple following on Thursday. Alphabet has significantly outperformed its peers, nearly doubling in value over the past year and leading year-to-date gains. Analysts anticipate Alphabet will report earnings of $2.64 per share on $92.2 billion in revenue, representing year-over-year changes of -6.1% and +26%, respectively. Key areas of focus will be cloud revenue growth, which accelerated to 48% in the previous quarter, and search performance, expected to be in the +17% to +18% range. Investors will also be keen to hear how Alphabet is monetizing its substantial investments in artificial intelligence, with AI now generating roughly 75% of Google's programming. Microsoft, considered the laggard within the group, needs to demonstrate momentum in its Azure business to regain investor confidence. While revenue growth in Microsoft's cloud business has been steady, concerns remain about capacity constraints. The company is projected to earn $4.07 per share on $81.4 billion in revenue. Overall, the Magnificent Seven are expected to show a combined +23% increase in earnings and a +22% increase in revenue for Q1. Across the broader S&P 500, earnings are forecast to rise +14.5% on +9.7% higher revenues, continuing a trend of improving earnings outlooks largely driven by the tech sector. Looking ahead, estimates are up for tech, energy, basic materials, utilities, and business services sectors, though energy's gains could be reversed if optimism surrounding the Iran conflict fades. Conversely, estimates have been cut for transportation, autos, and consumer discretionary sectors. Early Q1 results from 138 S&P 500 companies show a +23.1% earnings increase and +9.6% revenue increase, with a strong majority beating both EPS and revenue estimates. Beyond the earnings cycle, analysts are also highlighting the potential of quantum computing, predicting it could be the next technological revolution. Major players like Microsoft, Google, Amazon, Oracle, Meta, and Tesla are actively integrating this technology, and Zacks Investment Research has identified 7 stocks poised to lead the quantum computing landscape. Stocks experienced a mixed session on Monday, with investor focus shifting to earnings reports and geopolitical developments. Key companies in the spotlight included Alphabet, Primoris, and Rocket Lab. The Nasdaq hit a new high following an extension of the U.S. ceasefire in Iran, while earlier concerns about escalation had briefly pulled stocks lower. Several earnings reports are due this week from major players like Google, Amazon, Tesla, and GE Vernova. The market is also closely watching the Trump-Xi meeting and its potential impact on global trade, particularly in the rare earth sector. Additionally, the upcoming earnings season is expected to reveal whether megacap tech companies can demonstrate profitability from their AI investments. Investors are navigating a volatile landscape, with ongoing analysis of asset flows, sector rotations, and economic data to identify potential inflection points and outperform the market. Concerns surrounding the Israel-Iran conflict and a recent Supreme Court ruling striking down Trump tariffs are adding to market uncertainty. IBD is highlighting tools and strategies for investors to manage risk, screen for leading stocks, and leverage the IBD methodology for potential gains, including updates to platforms like MarketSurge and IBD Digital. In a significant challenge to Alphabet Inc.'s climate strategy, Trillium Asset Management is launching an exempt solicitation urging shareholders to vote for Proposal 5 at the company's June 5, 2026 annual meeting. The proposal demands increased transparency regarding Alphabet's plan to achieve its ambitious 2030 greenhouse gas emissions reduction targets. Trillium's move comes after Alphabet reported a concerning 51% increase in emissions since 2019, a figure that has raised red flags for investors focused on sustainability. The firm is specifically requesting a detailed report outlining Alphabet's emissions reduction pathway, including contingency plans and strategies to manage the rapidly growing energy demands of artificial intelligence and its expanding data center infrastructure. Trillium argues that a forward-looking climate transition plan is crucial for investors to accurately assess management's credibility and the potential reputational risks associated with failing to meet climate goals. The solicitation highlights the importance of understanding how Alphabet's capital planning for data centers and clean energy procurement align with its climate commitments. The outcome of the June 5th vote will determine whether Alphabet's board will be compelled to address these concerns and publish the requested report, offering investors a clearer picture of the company's climate risk exposure and execution strategy. Trillium frames the enhanced disclosure not just as an environmental imperative, but as a vital tool for evaluating the risks associated with community opposition and ensuring alignment between AI investments and broader climate objectives.